Welcome to this explainer. What if I told you that the absolute biggest factor driving the global economy isn't the Federal Reserve or inflation rates or some incredibly complex mathematical algorithm? It's actually the exact same primal emotion that makes someone buy a lottery ticket when the jackpot hits $1 billion. Crazy, right? Today, we're unpacking the hidden psychology of money. We're going to explore how raw, primal human emotion, rather than pure data, is the true, unseen force steering the financial world around us. And more importantly, we're going to break down exactly how this hidden force impacts your very own wallet. So, what really drives the economy? We're consistently taught in textbooks that markets are these perfectly rational machines. We're told they operate on cold, hard data, perfectly pricing in every piece of logic available. But, come on. Contrast that rigid, boring math with the sweaty, chaotic reality of a trading floor. Or remember the sudden consumer panic over toilet paper? The economy often feels like an absolute roller coaster, soaring on the most euphoric highs of optimism and plummeting into the deepest, darkest depths of fear. This huge disconnect between what we study in a classroom and what we actually experience out there in the real world, it suggests a totally different reality is at play here.
Let's dive right into this with part 1, the myth of rational markets.
Okay, picture this. The year is 1936. The world is deeply in the grip of the Great Depression. Breadlines are long, morale is incredibly low, and right in the middle of all this despair, legendary economist John Maynard Keynes introduces a truly groundbreaking concept. He argued that massive economic decisions, like building a gigantic new factory or hiring 1,000 workers, well, they aren't solely based on cold, hard calculations. They just can't be. Instead, he proposed that these massive investments are heavily influenced by a spontaneous optimism. It's a gut feeling, an intuition, just a sudden burst of sheer confidence that completely lacks a purely rational mathematical basis, yet pushes people to take massive risks anyway.
Keynes gave this deeply human phenomenon a really memorable, almost wild name: animal spirits. It's basically our innate, powerful tendency to act on impulse, hope, or fear rather than objective data. Think of it like an invisible hand, but unlike Adam Smith's famous invisible hand that calmly punches numbers into a calculator to perfectly balance supply and demand, this hand operates purely on adrenaline and anxiety. These animal spirits can violently push an entire economy up into a massive, booming frenzy, or literally drag it down into a devastating, paralyzing bust, completely defying all logical predictions. Decades later, modern economists like George Akerlof and Robert Shiller expanded on this brilliant concept. They explained how these primal emotions create massive, self-fulfilling prophecies through a deeply embedded psychological feedback loop. Imagine you're in a crowded, pitch-black theater. If just one person suddenly shouts fire, even if there is absolutely no fire at all, that collective panic instantly creates a psychological wave. And that wave, it causes a very real, very dangerous physical stampede. Well, the global economy behaves the exact same way. When optimism is high, people eagerly spend, businesses rapidly invest, and the economy grows, which, naturally, just creates even more optimism. But when fear suddenly takes over, spending stops dead in its tracks, the economy grinds to a halt, and boom, the panic stampedes. Which brings us to part 2, anatomy of a market bubble. Let's look at how this actually plays out in the real world. We're going to use the late 1990s dot-com bubble as our prime example here. Normally, a rational market relies on fundamentals, right? Things like actual profits, sound valuation, and solid revenue data. But during this era, infectious optimism completely took over. I mean, a company could literally just add .com to the end of their name, announce a flashy website, and watch their stock price double overnight. No joke. People were completely ignoring the fact that these companies had absolutely zero profit. They were investing purely out of raw excitement and an overwhelming fear of missing out. Because their neighbor just bought a new boat with tech stocks. The animal spirits had firmly grabbed the wheel, and the math was thrown completely out the window.
But here's the thing. Animal spirits are incredibly fickle creatures. When just a few of those high-flying .com companies inevitably ran out of cash and failed, the collective mood violently, aggressively shifted. That euphoric optimism instantly mutated into pure, unadulterated fear. Confidence completely evaporated in a matter of days, and the bubble spectacularly burst. Trillions of dollars in wealth were wiped out globally. Trillions. Just let the absolute gravity of that number sink in for a second. And here's the fascinating kicker. The underlying internet technology driving all of this? It was still completely revolutionary. The hard data hadn't changed its long-term trajectory at all. But the collective mood had changed, and that sheer panic took the entire market down with it.
All right, let's bring this a little closer to home with part 3, psychology and your wallet. So we can easily see how this chaos plays out on a massive, global scale. But we really need to look in the mirror here. If the entire global economy is essentially driven by these collective mood swings, we have to ask ourselves, are your own emotions secretly costing you money? Think about a recent, sudden purchase you made. Maybe upgrading a phone you didn't really need just because everyone else had it, or maybe panic selling a stock when the news looked bad. We've all been there. Are your personal animal spirits preventing you from making smart, rational financial decisions for your future?
To fix this, let's jump into part 4, the emotional temperature check. To protect yourself in an economy that is clearly driven more by mood than math, you really need a systematic protocol. Think of it as a 3-step emotional temperature check. Step 1, recognize the mood. Before making any financial decision, just pause. Is there widespread euphoria in the air, or is the news cycle filled with just total gloom? Acknowledge that collective vibe. Step 2, check your own pulse. Are you feeling overly optimistic just because your friends are bragging about their recent gains? If so, step entirely away from your phone or computer for an hour before hitting that buy button. And step 3, counterbalance with data. If everyone around you is panicking, actively hunt for signs of underlying strength. You consciously have to force data into the equation to temper those emotional impulses.
So how do we actually master this? That's part 5, mastering your animal spirits. Recognizing the problem is really only half the battle. So here are 3 highly actionable ways to harness these forces rather than being driven by them. First up, automate your investing. Strategies like dollar-cost averaging completely remove your flawed Bailey emotions from the equation. It effectively forces your money into the market on a rigid schedule, totally bypassing that animal instinct to hoard cash when the market is terrifyingly down. Second, build an emotional buffer. Having a solid emergency fund neutralizes fear. An economic downturn won't force you into a panicked, sell everything at the bottom kind of decision, because you know you have a safety net. And third, diversify your information diet. Seriously, doom-scrolling financial apocalypse news will completely ruin your portfolio by keeping you in a constant state of anxiety. Seek out diverse, long-term analyses to help you actively resist that herd mentality.
To wrap this all up, let's do a really quick self-test. Think about a recent financial choice you made, or, hey, maybe one you're heavily considering right now. Take a second and ask yourself, was I primarily influenced by the general optimism or pessimism dominating the news cycle? Or maybe the constant chatter among my peers?
Question 2, and be completely honest with yourself here. Did I feel a strong, sudden urge to buy or sell something quickly? Think about seeing a specific cryptocurrency or meme stock spike 20% overnight. Did you totally bypass your normal, calm, calculated planning just to jump in on the hype?
And finally, question 3, did I purposely ignore objective data just because it contradicted my gut feeling? Like, actually, scratch that. Did you literally look right past the glaring, boring facts simply because they didn't align with your sheer excitement or your overwhelming fear in that exact moment?
Listen, if you answered yes to any of those questions, you felt the undeniable primal pull of animal spirits. It's a completely natural human tendency that connects us all. Absolutely no one can perfectly predict the market, but by acknowledging your animal spirits, you stop being a blind passenger to your own emotions. So, the next time you go to make a major financial move, take a deep breath and ask yourself, who is really making this choice? You or the animal? Thanks so much for joining me on this explainer, and I'll catch you next time.